Stop out in Forex. A stop out is an automatic mechanism that brokers use to close one or more of your open positions when your margin level falls below a certain threshold. It's a last resort action taken by the broker to prevent your account from going into a negative balance and limit losses. For example, if your broker has a stop out level of 50%, it means that if your margin level drops to or below 50%, the broker will start closing your positions automatically. Stop out and margin call. Margin call is a warning that your margin level is too low, and you need to deposit more funds or close some positions to avoid a stop out. The broker asks you to take action before the situation worsens, while stop out is final action. If you don't respond to the margin call and your margin level keeps falling, the broker automatically closes positions to prevent your account from going into the negative. Let's look at an example. Let's say you deposit $2,000 in your trading account. Then you decide to open several positions, requiring a total margin of $1,000. Your broker's stop out level is 50%. Your equity drops to $1,000 due to losses, and your margin level is now 100%. The market continues to move against you, and your equity falls to $500. So, now your margin level is 50%. At this point, the broker automatically closes the most unprofitable position to protect your account from further losses. So, stop out protects both the trader and the broker from excessive losses. Understanding stop out levels is essential to prevent forced liquidations of trades. Traders should manage risk by monitoring margin levels, using stop losses, and avoiding over-leveraging. That's all about stop out in Forex trading. Thank you for watching. Stay awesome and keep tuning in. See you in the next video.